Working capital can be measured two ways. Net working capital is your current assets minus your current liabilities. The working capital ratio is your current assets divided by your current liabilities. Current assets are generally assets that will be converted into cash within a year, and current liabilities will be paid in cash within a year. So these metrics are a rough estimate of whether you will receive enough cash in the next year to pay for what you owe in the next year. That's why the working capital ratio is used by lenders to determine whether you are financially healthy enough to receive a loan. For both formulas, a higher number is better. Here's a sample company balance sheet to show the current ratio calculation. This is a classified balance sheet, so current assets have been subtotaled and current liabilities are also subtotaled. Current assets are $600,000, and they are divided by the current liabilities of $350,000 to arrive at a current ratio of 1.71. Once you know the ratio, that leads you to the question, is 1.7 a good or a bad ratio? If I told you that my net working capital was $100,000, it doesn't tell you very much. It would be huge if my liabilities were $10,000, and it would be tiny if they were $10 million. If I tell you my ratio, you instantly know something very important based on whether it's above or below 1.0. If it's below 1, my current assets are less than my liabilities, so I may not have enough cash to cover everything I need to pay in the next year. If it's greater than 1, it's more likely I'll have the cash to cover my liabilities. The amount the ratio is above 1 tells you the cushion that you have above your current assets equaling your current liabilities. You just take the amount above 1, multiply it by 100, and that's the percent cushion I have. So, if I tell you that my current ratio is 1.25, you instantly know I have enough current assets to cover my current liabilities plus a 25% cushion. Is a 25% cushion enough? It may be if I have predictable net cash inflows and access to cash. I would need more of a cushion if I didn't. The quick ratio is also known as the acid test ratio. Frankly, that's a pretty extreme title for an accounting metric, but it sounds cool. It's calculated as current assets, less inventory, prepaid expenses, and supplies divided by current liabilities. This ratio removes some illiquid assets and is a tougher test of your cash flows than the current ratio. Like the current ratio, higher is better from a cash flow perspective. A common recommendation is for this to be equal to 1 or higher. We're back to sample company's balance sheet to look at their quick ratio. Their total current assets are $600,000, but for the quick ratio, you take out $300,000 of inventory, leaving $300,000. That's divided by the current liabilities of $350,000 for a quick ratio of 0.86. As mentioned earlier, a common recommendation is for this to be equal to 1 or higher.